Shankar. Thank you for joining me for the Trading Markets Golden Rules of High Probability ETF Trading. The Golden Rules are based on quantified test data. We have found that conventional wisdom can often be wrong, so it's best to test any idea before putting money at risk in the stock markets. The Golden Rules have withstood the test of time. Many of these rules were identified in the 1990s using data from the 1880s and onward, and they continue to hold true 25 years after they were discovered. Now, when we define high probability trading, we're talking about ETF strategies that are successful at least 65% of the time in backtesting. We believe that with high win rates, the probability of being successful in the long run is dramatically increased. We can demonstrate this mathematically with the principle of mathematical expectancy. Mathematical expectancy takes the average percent P&L, which is the average percentage gained or lost on all trades, and the percent of winning trades. And we multiply the percentage of winning trades times the average percent P&L, and we subtract from that the percentage of losing trades times the average percent P&L. Now, in a worst-case example, using our floor of a 65% win rate, and just a small trading edge demonstrated with an average percent P&L of 0.1%, the strategy would be profitable. As we show here, with the mathematical expectancy indicates there'd be a 3% total return on that strategy. A more realistic example, and as you can see in other videos, we have many strategies that have win rates exceeding 75%, and we have strategies with the average percent P&L that is greater than 0.5%. Using just this realistic example of a 75% win rate and a 0.5% trading edge, we find the expected total return would be 25%. The high win rate clearly makes a difference in profitability. High probability strategies also reduce the risk of ruin. If the chance of success on any individual trade is high, we would expect the long-term success probability to also be high. Now, the risk of ruin is the chance that a string of losses will deplete your trading capital and make it impossible to continue trading. If that string of losses, perhaps 10 losses in a row, occurs right when you begin trading, it's possible that you would not be able to continue trading. By having a high probability of success on any individual trade, we decrease the risk of ruin and make it more likely you'll attain long-term success. Our data and testing has shown us that short-term traders benefit from mean reversion. We have found two basic tendencies in the stock market. Over the long run, stocks have a tendency to trend, and there is an upward bias in this trend. In the short term, there's a tendency for prices to exhibit mean reversion. These principles lead us to the golden rules. You should always trade with the trend. By this we mean only buy ETFs when they're trading above their 200-day moving average, and only short ETFs when they're below their 200-day moving average. This takes advantage of the tendency of stocks to trend in the long run. To benefit from mean reversion in the short run, we recommend buying ETFs on pullbacks rather than breakouts. We recommend shorting ETFs into short-term strength, and we recommend using dynamic exits. Now, a dynamic exit is one that adapts to the current market conditions. An example would be a 5-day moving average. For example, you could buy on a pullback below the 5-day moving average to take advantage of mean reversion and buy on a pullback, and then sell when the close is back above the 5-day moving average. We've also found ETFs can be more profitable for traders than stocks in some ways. Sector ETFs, for example, tend to move from overbought to oversold more reliably than individual stocks. This is also true when moving from an oversold to overbought condition. Country ETFs tend to move even more reliably than sector ETFs. Incorporating this knowledge into your strategy can help you find multiple trading opportunities that will reliably deliver high probability returns. We also believe that it's important to understand what you're trading. Just because a strategy works well for sector or country ETFs, do not expect it to work well with inverse or volatility ETFs. These ETFs, the inverse and volatility ETFs, are constructed differently, and those structural differences matter for ETFs. The costs of holding swaps and derivatives, for example, in a volatility ETF make it much different than the cost of owning stocks in a sector ETF. Now, new ETFs are continuously being developed and could provide new trading opportunities for you, so we encourage you to watch for new developments on the ETF front. In summary, the golden rules of high probability ETF trading indicate that it's most likely to be successful if you buy ETFs on short-term pullbacks during long-term uptrends. You're also highly probable to find success shorting ETFs on short-term strength during long-term downtrends. And we also encourage you to watch for new trading opportunities as new ETFs are launched. We hope you'll find our other strategy videos to be as useful as this one, and we encourage you to explore the many high probability trading strategies we have at TradingMarkets.com.